The stock market has been declining for the last few weeks and people are getting concerned. Are we going to recover? Is there a chance for another high, or are we actually moving into a bear market? So we want to take a look at that today. We'll take a look at an indicator and also the Elliott Wave count. Let's go. Yeah, hello and welcome to another video by MCO. My name is Ben and today we want to take a look at the S&P 500. A lot of people are scared at the moment. There is a lot of uncertainty in the market, not only the stock market, also the crypto market. Today, however, we want to take a look at the S&P 500 and we want to take a look at a very important indicator as well. Or at least something I discovered which I found quite interesting, which is worth sharing. And that kind of indicator has a very good success rate and it kind of points towards another recovery that could be around the corner, but we will take a look at that right now. So I want to first start not on the Elliott Wave price chart, but actually on the Fear and Greed Index. So it is currently at an extreme level. So from a sentiment point of view, that is always very interesting for me because Elliott Waves obviously relate to sentiment as well. And when we are at an extreme level here on the Fear and Greed Index, and we're also arriving at a key level on the price charts, that's very, very interesting. So typically extreme fear could indicate that we are close to an upside reversal because the sentiment is just the right one for a trend reversal to the upside. However, that being said, I'm not saying that I'm super bullish on the stock market. We are pretty much at the end of a major rally, but if you watched my previous video on this channel, then you know that I'm trying to prepare people for a major bear market that is around the corner. Just cannot confirm it yet. And as you will see on the chart, I'm still kind of slightly in favor of another high. So keep that one in mind. Obviously, extreme fear. Something interesting that's worth sharing as well is the VIX, the Volatility Index. Typically, when it's high, then it has been going up here since sort of mid-February, then that indicates as well that there is a lot of fear in the market. People are concerned. It could certainly go higher, but typically when it starts dropping, it indicates a recovery on the S&P 500. And the higher we go, it would indicate a recovery is around the corner for the S&P 500. So it can be used for sentiment studies. You can also trade it, not directly the VIX, but there are other instruments that you can use to trade or as a hedge, for example. But I just find it interesting from a sentiment point of view. And we've certainly broken above a key level here around sort of 23 points. And we're getting into an area that you could, maybe even class as overbought, kind of, but not yet. But still, it shows there is concern. People are concerned, investors and traders are concerned. A high VIX typically indicates uncertainty and fear as well. What is interesting now is this indicator. I kind of stumbled over here on X, and SuperTrade posted that one, so greetings. What I found interesting is just that, when we had a certain number of days, especially 6 consecutive days of, let's say, higher volatility on the S&P 500, while not being in a bear market. That's very important because typically when we say the price has dropped more than 20% or 20%, bit more than 20% since the last all-time high, well, that indicates we're in a bear market. We're not there yet. I mean, S&P 500 has dropped like maybe 7, 8, 9% from the all-time high. That's not bear market quality. So as long as that's not the case, this indicator in the past, whenever we had 6 consecutive days of high volatility, typically 2 months later, we had green results. So what does it mean? It means if you have a lot of volatility, at the moment there is a lot of volatility, but we are holding still in an area that's not classed a bear market. So we're still in a bullish market. That's very important. And to be honest, we will see on the price chart, it's not a significant decline that happened, but people still get very concerned. Well, okay. I mean, I get it. I've been warning about a large correction on the S&P 500 for quite some time, but I try to help people understand that we are in this area where we just have to expect that. We have to expect that a bear market starts at any point. I can't confirm it yet, and I still would like to see actually one more high. I think that would still be the most probable scenario. However, the market is now arriving at key levels. Yeah. So again, that's just something, let's say positive, maybe a bit of hopium. It is just there. The data is there. The facts are there that where we had a similar situation of the same volatility after 6 consecutive days, and then we are not in a bear market, then typically whenever that happens, and we are in that situation right now, and the VIX shows that volatility as well, then typically 2 months later, there has been a very positive development and we were higher than, kind of before, right? The market kept going up. So you see it up here as well. You can check that out. I'll link it in the description. But what I now want to take a look at is the S&P 500 chart, of course. So let's just remind ourselves here what's happening here on the weekly time frame for the S&P 500. Here, quick reminder, we are really in the late stages. My assumption is still that we are in the the rally, it's running kind of on its last legs. The price is likely at the end of a major bullish market. Talked about before, all of that, we can zoom out a little bit, but we're pretty much in the 5th wave, of this larger degree 3rd wave, and that wave 5 of 3 started 2009, and here this wave count to the upside looks pretty much complete. So I am preparing for a rollover. It might not happen yet, okay, and that's where we take a look at the smaller time frame. I'm not going to talk about really the microstructures, but just wanted to remind you that if this 3rd wave finishes, and this is kind of a decade-long bull market that kind of is complete or nearly complete, well, we have to expect a bear market is starting. This is a larger degree 3rd wave, and I'm going to open the monthly chart briefly as a reminder, because we talked about that a while ago, like I think maybe a month ago on this channel, one of my first videos on this channel. We have arrived at an absolute key trend line as well on the monthly chart. You see that when we zoom out a little bit, there is a trend line on the monthly that can act as resistance, and this is the correction would most likely be, or it could be, we have to prepare for that. It could be the wave 4 that relates to the wave 2 that happened in 1932. So it's as I said, nearly 100-year-long bull market that could be coming to an end. It's probably not, we're probably not there yet, okay? We probably haven't topped yet, but we are in that area where that could happen at any point. The wave count is full. You see we have 5 waves up from the 2009 high, and we also have a pretty full wave count from the 2020 low. Sorry, we have a pretty full wave count from the 2009 low, and we have a pretty full wave count as well from the 2020 low. And we've arrived here at a key trend line, and the market so far could not really break above, okay? Now, that being said, what I want to show you as well on the weekly chart probably is better. People talk about the 200-day simple moving average. So that is one that is absolute key. Let me open that, and we can adjust that here on TradingView, pretty much live, 200, and then we select the daily, and we make it a little bit more visible here. So do get concerned that we might drop below this this 200-day moving average. Okay, we're still holding above it. But the last time that happened, we broke below it was in 2023, obviously, and we all know what happened afterwards. So there can, without a problem, be a brief break below it. It wouldn't be a major problem. So we're still holding above it, however, at the moment. Still, though, that is something to keep in mind, that just a brief break below that 200-day moving average wouldn't be a disaster. Yeah. Still holding above it. It acts as support right now, but we have to see now how in this week the S&P 500 performs. Now let's take a look at key Fibonacci levels, because that's really important. So bottom line is we have a very full wave count. The macro risk is really high, but we have no topping confirmation yet. We're still holding above the 200-day moving average. Even a slight break below it wouldn't be a problem. We have a decline from the all-time high of around, let's say, 8%. That is not bear market quality yet, but we're approaching kind of the 10% mark. These are very important levels for sentiment as well. And when we take a look at the smaller time frame here for the S&P 500, I'm not going to dive into the microstructures here, yeah, but just looking at the 1 hour time frame, we can still make a case, and this is the yellow scenario here, for one more high. For me, the key bull bear pivot, you could say, is at 5,477. I mean, actually, it would already be ideal for the price to hold 5,592. Any break below that would be deep, but it's still acceptable. Yeah, but you see, let's see where we open that. So yeah, it depends on how we count it, but I can make a case still for a deep wave 4 and a potential diagonal pattern to the upside. Still though, 5,592 would be an ideal support level to hold. Ideally holds here, yeah. I can tell you that the wave count that I have here, it suggests a flat correction, yeah. And we're currently in an ABC structure to the downside, and that C wave is, I mean, it's long enough. What I normally do as well, I take the length of the first move down, which is the wave W here. I go to the high of the X wave, and then it is typically the area between the 100% extension and the 161.8 extension where we want to see a reaction. And I mean, we are there now. The price has reacted to the 138% extension, right? But whether that's already a reversal or not is a bit too early to say. I can definitely make a case for one more low. I really don't want to see much more downside though. I really don't want to see much more downside. Now, these videos are recorded a little bit in advance, so again, that's the reason why I don't want to dive too much into the microstructures, but I believe we could be close to a reversal, but it takes a break above key levels to confirm it. I mean, the first indication a low is in would be a break above 5,824. Better though a break above these swing highs. That's really important here at 5,865. So yeah, overall, in summary, I mean, we are pretty much in an area where a larger top could form at any point. The rally on the S&P 500 and Nasdaq as well, we talked about that in one of the last videos. They are running on their last legs, but I don't have any evidence that a major top has formed yet. Definitely, I will keep looking for signals that a major top has formed. I will keep you updated. If you're interested in really short-term updates for the S&P 500 and the Nasdaq daily video updates, check out our stock service. It is linked in the video description. I wish you a great day, and let me know in the comments if you like, if you have certain suggestions for certain video topics, and hit the like button, leave a comment. Thank you very much. Bye-bye.